Hello and welcome to this episode of Macrosutra. I'm Akanksha Mishra. As we delve into a new week with new tariff wars and new uncertainties, it's time to take a look at some key indicators that are going to help us understand the health of the US and Indian economies. To dissect this, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you for being with us, Radhika.
Thank you, Akanksha.
Let's start off with the United States. How have Trump's tariff announcements affected consumer sentiments in the country?
As you rightly mentioned, this is the right time to have a look at the various indicators because we've had a fortnight where tariffs have been subject to a switch on, switch off policy. We have seen various flip flops on tariff policies, and all that is getting reflected in the various high frequency indicators that are now coming up in reflecting the impact of these policy uncertainties. The very important one of the important indicators is to look at consumer sentiment, and for this we look at University of Michigan's Consumer Sentiment Index. It's a widely reported, understood, tracked index of consumer sentiments, and it shows that it has plummeted to a value of 50 in April. Right now we are in April, but they give a preliminary reading, and then once the month is over, they give the final reading. But there is a consistent drop in consumer sentiments that we have seen over the last 3-4 months, and now it has dropped to 50, which is very low, and the value is similar to the values that were seen during way back in November 1981. So it is quite a low value, and also if we corroborate this by looking at some of the reported instances of spending patterns, when sentiments are low means people scale back their spending because they are not aware of what's in store for them. So we've seen that there are several newspaper articles and several reports that point out that one of the key segment of consumers in the US, that are young women, they have scaled back their spending, and so that's now become a very good indicator of consumer sentiments going forward. So there we've seen that there has been a scale back. So that is one thing. Consumer sentiments is down, and that is down because of uncertainty that is also linked with inflation expectation, because consumers expect that 1 year down the line inflation is going to rise, because once the impact of tariff comes into full swing, they do not know what will be the direction of prices of various goods. So overall their inflation expectation has edged up by a considerable amount, and therefore their sentiments have gone down by a considerable amount.
Now, despite consumer expectations of inflation rising, there's also signs of recession in the US economy. So, can you talk about this dichotomy?
Absolutely. As you rightly said, on the one side, sentiments are down and inflation expectations are up, and all that is getting reflected in also there is this sign of mounting recession. For this, we look at the Federal Reserve Bank of Atlanta's nowcast estimate. Nowcast tells us what is going to be the growth rate of the quarter that has just ended, that is the January to March quarter, and it's a running estimate as and when new indicators come up, which are actually used by the US Statistical Agency Bureau of Economic Analysis. They keep updating their estimate of the growth estimate for the January to March quarter, and it is showing a negative growth, or in other words a degrowth of 2.2%, 2.4%. That keeps getting updated, but the key point is that in February, the same quarter, the nowcast was above 4%, and now it has slipped down to 2.2% or 2.4% because of these Trump related policies and uncertainties, which on the one side will increase prices, and on the other side will depress demand, will suppress demand, will have an impact on incomes, will have an impact on labor market going forward, and as a result, a culmination of all these factors will show up in growth going down. So now there are various estimates of nowcast. one, which is the Federal Reserve Bank of Atlanta, is pointing out towards a contraction. But even if we look at the various estimates by standard setting agencies, they have downgraded their forecast of US GDP growth for this whole calendar year 2025, and they have raised the probability of recession. Now, recession, when they are saying they have raised the probability of recession, mean the textbook definition of recession, which is 2 consecutive quarters of GDP contraction. So that is what is recession. So they have upped their probability of recession because of uncertainty, because of fueling, because of this tariff war fueling price inflation, and the threat of this now complete decoupling between US and China is going to have profound implications for the US economy.
Yeah. Now, let's talk a little bit about the US Treasury bonds and the
Right.
dollar. So, what has been their status in this period of market correction?
Yeah, so that has been a very surprising term that the trajectory of US bonds and US dollar has taken, which again has something, it's going to have a deeper implications over the coming days or months. So, if we consider the period between 2nd April and 9th April, this was the period. 2nd April, the Liberation Day tariffs were announced, and 9th April, the tariffs were withdrawn. During this period, we see that S&P, which is the standard in the US stock market, it tumbled. Normally, what happens is when the equity market tumbles and when there is this market turmoil, investors tend to move towards the safety of US Treasury securities, because US Treasury securities are considered as safe haven assets.
Yeah.
So there is increase in the demand. When there is increase in the demand for such treasury bond, it increases their price. Price and yield are inversely related. So when prices rise, yields fall. And when yields fall, it reduces the cost of borrowing for the government, which is a good thing. But this time around, the reverse of that happened, that in the times of market correction, when the all equity market, Nasdaq, S&P, all were tumbling after the reciprocal tariff, the bond market also started to, the bond yields also started to rise. In other words, the prices fell and yields rose because investors of bond market also started selling. So, in other words, what it tells us that investors are getting nervous, jittery about the credibility of US
Yes, policy.
policy. They are getting nervous about the credibility of policy certainty, and therefore, this thing erodes the safe haven status of US dollar and dollar backed assets. So, that has what has happened. There are also these speculations that China and Japan are the major holders of treasury bonds, US treasury
Yeah.
bonds, and because a lot of tariff was imposed on them, as a retaliatory action they sold US bonds. But that doesn't seem to be a very plausible explanation, because if China does so, China will suffer because they're holding so many bonds. They will have mark to market losses. So it is not just foreign investors, it is the domestic investors also who started offloading their bonds,
Yeah.
which led to a decline in prices of bonds and an increase in yield. So normally it's a very interesting graph that we make, where we show the 10-year bond yield and the dollar index. So 10-year bond yield during this period from 2nd to 9th April, the 10-year bond yield rose because reflecting the decline in prices and people offloading bond, and dollar depreciated. So normally it is the other way around, that dollar appreciates and bond prices rise and bond yields fall, but this time around the opposite thing happened. And this has implications for the US cost of borrowing, because if the yields on bonds will rise, the US cost of borrowing of the government will rise, and if the government rises, it will also increase the cost of borrowing of households.
Consumers.
Credit card spending will increase,
Yeah.
home loans will rise, auto loans will rise. So there will be, and that will again have negative impact on consumer spending, because a
Right.
lot of that of your discretionary income will go towards interest payments, so that will suppress your consumption.
Speaking of domino effects, let's come to India. Realistically speaking, how dependent is our economy on the US and on global markets? And how will this period of turmoil affect our economy's health?
Yeah, so there is a lot of this comfort drawn from the statement that India is a domestically driven economy.
Yeah.
It is governed primarily by domestic consumption. 60% of GDP is domestic consumption, which is all true. But over the course of years, our exposure to the US and global growth has increased because the volume of trade of both goods and services has increased. So whatever happens in the US, if there is a general slowdown, that is going to impact India through various channels. The most important, obvious channel is the balance of payments channel. Within balance of payments, we have two primary accounts. We have the current account and the financial account. In current account, we mainly talk about exports and imports of goods and services, and in financial account, we talk about FDI and foreign portfolio investments. Now, exports are, if we first look at the data for FY25, because now we have the full year data came out on 15th of April. We know that exports have posted a very meager growth of less than 1%.
Yeah.
And that was mainly, to be sure, driven by low oil exports. But now, given the tariff related uncertainty, the goods exports are likely to be hit. There would be some cushion if we come up with a trade deal with the US, but then we'll have to sacrifice our trade balance, because right now we have a trade surplus. We'll have to have reduced trade surplus. We have to give them some amount of surplus. So that is one. So that is the impact on exports, which is going to suffer. And on the import side, there is greater possibility of dumping happening from China, because now, as I said, US and China are effectively decoupled. Now we know that US has imposed a tariff of 245% on China, and China has effectively stopped its supply of rare earth minerals and Boeing. So they have effectively decoupled these two countries. These two are big major trading partners, and if they decouple, it will have implications for the rest of the world. Both China and the US will try to find alternative markets for their products, for the goods they trade with each other. So there is a greater possibility of dumping happening from China. There's also greater possibility of dumping happening from other countries,
Yeah.
like Vietnam. Now, Vietnam is a major supplier of footwear to the US.
Yeah.
Now, if Vietnam is subject to higher tariffs, they might start dumping their products to India. So one is the possibility of export being hit, so exports will be lower and imports will be higher. So our current account deficit is expected to rise. So that's the first impact. And the second, the markets are likely to remain volatile. There will be periods when markets will shoot up, when there is some reprieve on tariff announced, but overall markets are likely to remain volatile. And when we bring these two factors in conjunction, that is current account and financial account, overall balance of payments is likely to remain under pressure this year.
And also, if we talk about inflation, is there any threat of inflation in India right now, given the situation of the global economy?
Yeah, so while there is threat of inflation in the US, and Fed has to grapple with this policy trade-off between slowing growth and rising inflation, right now we don't see inflation being a major concern in India, and that also eases up, provides some room for repo rate cuts going forward. So we have seen that inflation data came out 2-3 days back, and inflation has fallen to below 4%, mainly due to lower food prices. And also there was an announcement that this year rainfall is expected to be good, above average. That bodes well for food inflation outlook for this given year. And commodity prices are down. We know that global oil prices are down. That prompted government also to increase duties to get some revenue and not pass on the benefit to consumers. So overall, the two key drivers of inflation as of now look benign. So inflation is expected to be closely aligned to the 4% target, and that gives some comfort from the policy side, from the monetary policy side, that there could be room for further easing.
Hmm.
Because on the fiscal policy side, nothing can be done much, because we've already cut corporate tax earlier. Now we have announced cut of income taxes.
Yeah.
We've also announced our glide path on fiscal policy. So there's nothing much as of now that fiscal policy can deliver. But on monetary policy, we can have rate cuts going forward, and that's a some support is coming at least from the domestic side of inflation, and that will help in the
Yeah.
given scheme of things.
Now that that's inflation's tackled, finally, I think the last question should be what should be the Indian government's current plan of action to deal with the Trump tariff uncertainty?
Yeah, so that is the most important question, that what should be the uh, policy strategy going forward. One thing is that we have already announced reduction of tariffs in the last 2 years budgets, and that policy agenda should continue, and that should form part of commitments that should be a part of our negotiations when we deal with the US in finalizing our trade agreement, that we are open to substantial duty reduction that provides competitive improvement to our sectors. Now, here it's important that focus should be on labor-intensive sectors, because there the cost of realignment of global supply chains, the global
Hmm.
value chains is much lower. It will be easier for us. And in the last episode, we discussed that there are some sectors where there are window of opportunity, like we talked about leather, we talked about footwear. They are all major labor intensive sectors. So if we can reduce duties, and if we can have these sectors as part of the negotiation, that will certainly help in improving our market share. So that is number one, that we should have a calibrated approach towards import duty
Hmm.
reduction. The other is that we should accelerate our negotiations with non-US countries. We have an FTA negotiation going with the EU, with the UK. All these FTA negotiations should be accelerated.
Yeah.
Focus should be not just on tariff barriers but also on non-tariff barriers. So it has to be a comprehensive deal, and FTAs with ASEAN countries need to be
Yeah.
relooked. And third most important thing is that we need to have a strategic push towards diversification of our product base as well as trading partners,
Yeah.
so that we can shield ourselves from this continued uncertainty about the tariffs by the US. So that will help us in insulating if we have at least some countries with which we have the rule based trading arrangement, which is
Yeah.
based on the MFN treatment.
Yeah.
So I think those are some of the steps.
Great. Now I think it's time for some audience questions. First is by Aditya. He asks, do you think if inflation increases in the US and Feds over there increase interest rates, then would foreign investors return back to the Indian market, or will they want to stay in the US markets? Considering the fact that with increased interest rates, bond rates would also rise and investors would want to park their money over there.
So, as I said, this happens in the typical scenario, in a
Yeah.
normal case scenario. But as we have seen, that this conventional playbook has not played out in the last couple of days, where we have seen that whatever is happening, we have seen that bond yields, the US bond yields are rising, and that is growing indication of investors offloading or selling the bond, the holding of US Treasury securities, leading to a fall in prices and an increase in yield. So right now, what is important is that if there is lesser uncertainty, that will help foreign investors, be in US, be in India. So the conventional relationship that interest rate rise and therefore bond yield rise and therefore US investors, therefore investors move from India to the US,
Yeah.
that played out very well in 2022, but it may not play out now. So what is important is to have uh, greater policy certainty, and both economic policy certainty, trade policy certainty. And because just as a related point here, WTO released its global trade outlook last evening, and
Okay.
there they say that the volume of trade is going to fall substantially due to these tariffs. So all these will have implications for foreign investment flows as well, and just the differential in bond yields is not going to be the sole determinant of FPI flows.
Right. The next question is by Anubhav. We've already answered this, but I think let's just take it. It says, can you please list down the immediate steps Indian government should be taking in the next 1 year to tackle this business uncertainty created by Trump's trade wars and be imaginative? I think he's asking you to be imaginative with the steps.
No, I think it's we have to focus more on reduction of tariffs going forward. That is something that agenda of acceleration of reduction in tariff has to continue. Steps towards improving manufacturing sector competitiveness has to continue. Focus on labor intensive sectors is something that is needed going forward. There are also news that PLI scheme has been discontinued and it will be revamped. So it needs to be seen what is the government's policy push going forward.
Yeah.
But definitely, focus has to be on improving manufacturing sector competitiveness, number one. And secondly, strategic push towards trade diversification, because there is going to be a lot of dumping trade diversion happening from the US and China towards India. So we need to have a policy towards setting up trade partners with non-US countries so that we can have greater market share, and towards this entering into greater number of FTAs with more and more countries will likely help.
Yeah. Great. That's all we have for you today. Thank you for tuning into The Print.